All right, today we're diving into Primerica. From an investor's point of view, it's a fascinating company, a financial services giant with a business model that's, well, incredibly profitable, but also super controversial. So the big question is that controversy a red flag to stay away from, or is it masking a huge opportunity? Let's unpack it.
So just how big is the market we're talking about here? Well, it starts with this number, $14 trillion. Yeah, that's the estimated life insurance protection gap just for middle-income families in the U.S. It's this massive, underserved market that, frankly, most traditional financial firms just find too costly to go after.
And this is exactly where Primerica has stepped in. They've literally built an empire by serving this exact group of people. But for you, the investor, the real question is whether their unique, and let's be honest, often debated business model is a durable competitive advantage, or if it's more like a ticking time bomb.
Okay, so who exactly is Primerica's customer? Well, they are absolutely laser-focused on households that earn somewhere between $30,000 and $130,000 a year. This isn't Wall Street. This is pure Main Street America.
Their whole philosophy, their entire sales pitch, can be boiled down to this one simple phrase. Instead of pushing complicated, expensive whole life insurance, their message is simple. Get an affordable term life policy and then take the money you save and invest it. It's a really simple, powerful message that totally resonates with their audience.
So how does that simple idea actually make them money? Well, you can see that term life insurance is the foundation, making up 58% of their revenue. But the real story, especially for investors, is that growing slice of the pie, their investment and savings business. At 35%, this is the engine that the bulls believe is going to drive all the future profit. But to really get how they generate all that cash, you have to look under the hood at their sales engine. And this is, by far, the most controversial part of their business. It's really at the heart of both the bull and the bear cases for the stock. See, Primerica doesn't really have traditional offices or salaried salespeople. Instead, it operates through this massive army of independent agents. We're talking over 150,000 of them. And this structure, as you might have guessed, is often described as a multi-level marketing or MLM organization. So how does that actually work for the agents? It's basically a three-part system. You earn a commission when you sell a product, sure, but the real incentive, the way you make big money, is by recruiting new people and then earning a cut, what they call an override, from every single sale your recruits make. It's designed to be a powerful, self-perpetuating growth machine.
Now, despite all the controversy, or, maybe even because of it, Primerica is an unbelievably profitable company. So let's switch gears and look at the bull case. Why might an investor get really excited about this stock?
The bull case for Primerica really boils down to three main ideas. First, they've built this incredible moat by completely dominating a market that other firms just ignore. Second, their business model is super efficient and capital light, which just means they don't have to pour tons of their own money in to grow. And third, that efficiency means they generate a ton of cash, which they aggressively give back to shareholders.
And look, you can see that efficiency right here in the numbers. This chart shows the return on adjusted equity, or ROA. It's a key metric for how well a company turns its capital into profit. Primerica's ROA is expected to hit over 31%. I mean, to put that in perspective, most traditional insurance companies would be thrilled to get a number in the low teens. This thing is a highly profitable machine.
So how on earth do they pull that off? Well, they act more like a distributor than a traditional insurance company. Primerica basically offloads 80 to 90% of the actual insurance risk, the death benefit payout, to other companies called reinsurers. This keeps their own books clean, frees up their capital, and lets them just focus on raking in high-margin fees and paying out shareholders. And when we say they return capital, we mean it. For 2025, the board has authorized a massive $450 million share buyback program. So what does that mean for an investor? Well, by buying up their own stock, they reduce the number of shares out there, which automatically boosts earnings per share for everyone who's left. But of course, it's not all sunshine and roses. There are some pretty significant risks here that any investor has to think about. And that brings us to the bear case, which, ironically, centers on the very same model that makes the company so successful in the first place. The argument from the bears is that the company's greatest strength is also its biggest weakness. That MLM model? It comes with constant regulatory and reputational headaches. Their focus on Main Street? It means they're super exposed if the economy takes a nosedive. And that whole sales engine depends on constantly finding new recruits to replace the ones who quit, a system critics have nicknamed the leaky bucket. And this leaky bucket idea is absolutely crucial to understand. The turnover rate for agents is incredibly high. So for the business just to tread water, let alone grow, Primerica has to be in this constant state of recruitment, bringing in thousands of new people every year just to replace the ones walking out the door. Any hiccup in that recruiting pipeline is a direct threat to their growth.
And this isn't just a theoretical risk. We're seeing the stress show up in the data right now. This quote from the company's own analysis points out that when their middle-income clients feel the squeeze from inflation, that insurance policy is one of the first budget items to get cut. More people are letting their policies lapse, and that's a direct hit to what's supposed to be a stable revenue stream.
So here's the kicker. It's not just that clients are dropping policies. The agents themselves are struggling more. Average sales productivity has actually fallen. Each agent is selling fewer policies per month than they used to. That's a huge leading indicator that the economic pressure on their customers is starting to really bite into the core business.
Okay, so let's put it all together. When you look at Primerica stock today, what's the fundamental trade-off you're making as an investor?
It really comes down to this clear choice. On one hand, you have the bull case, a powerful, high-return business with a deep moat in a market nobody else wants, and it just showers its shareholders with cash. But on the other hand, you have the bear case, a controversial model with real regulatory risk. It's very sensitive to the economy, and it's totally dependent on that frantic, never-ending pace of recruitment.
Which leaves us with the final question every potential investor has to ask themselves. Primerica has, without a doubt, built a fortress, a really durable moat protecting a very profitable business. The thing is, that fortress is built in what you might call a risky neighborhood, one that's exposed to economic shocks and regulatory threats. So, is that powerful position worth the risks that clearly come with the territory? That right there is the decision on the table.